Hello again, everyone. It is Wednesday, June the 9th, 2021. I'm John Kosar of Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my top 5 charts and data series for the upcoming week. The ones that I think are going to have the biggest influence on upcoming price direction for the U.S. stock market. Number 1. Market internals. The Asbury 6 is positive. Those that have been following me on StockCharts.com, actually my last year Daily 5 was on May the 20th, are probably already familiar with the Asbury 6. The Asbury 6 is our daily health check on the internals of the U.S. stock market. It's updated every day in our research center, and it includes 6 different market metrics. Only one of them has to do with the price of the S&P 500 or the price of any index. The other 5 have to do with what I would call secondary indicators. Relative performance between stocks and bonds, asset flows, corporate bond spreads, volume, stuff of that nature. We did that on purpose because of the way the stock market trades now. 75-80% of the daily volume is algorithmic trading, computers trading. Thus, we get the volatility that we see day to day. The market's up 40 today, and it could be down 30 overnight and up another 50 the next day. It's very difficult to just focus on the price of the S&P 500 or any index and get a real handle and understanding of what's happening in the market. So we created the Asbury 6. We back tested these 6 metrics with each other for the purpose of most of them being right in terms of what's going on in the market most of the time. Problems with any individual indicator is none of them work all the time. So we kind of made a little team out of these 6. It helps to keep us on the right side of the market. It helps us to have a better understanding of what the internal condition of the market is when the S&P is jumping up and down by 40 points every day. So our Asbury 6 model turned back to positive on May the 27th to indicate a near-term internal strength. If you'll notice, the only red one or the only negative one is a rate of change. You can see it up here, and it is negative as of yesterday, which was June the 8th. And that's our slide number 2. Price momentum. It's actually been struggling since May the 11th, almost a month ago. And here's the monthly rate of change in the S&P 500 since the beginning of the year. We've got the S&P 500 up top. This is a daily chart. And then we've got the monthly rate of change underneath. The way the rate of change works is the indicator moves up and down through a zero line. And the zero line is kind of the line of demarcation between a positive and a negative rate of change. So you can see for most of the year, we have had a positive rate of change. There's been a few instances where it dipped underneath the zero line here to give you a negative rate of change. But generally speaking, if you look across the board here, all of these previous tests of the zero line were buying opportunities. We had one here at the end of January. We had a little one here at the beginning of March. We had another one here early to middle part of May. Let's call it the middle part of May. And now we're sitting right on the line again. So what that's telling me is even though the market has gone higher this year, there's been a lot of chop. There's been a lot of sideways movement. You could see it here between January and March. And you can see it again here, really since about the middle of April. What this tells me is the market's got to get off the dime here. The S&P 500 has to get off the dime here and start another move higher, or we are in danger of spending a sustained period of time underneath the zero line. If that happens, the rate of change turns negative and bad things start to happen in the market. So notice this also. From May 4th to 10th, we were underneath the zero line, just by a little bit, but that was the biggest dip that we've had up to that point. And then we had it again between May 12th and 20th. Again, it didn't go down very deep, didn't stay down there very long, but it shows you what happens. when the rate of change turns positive. So I think the takeaway here is S&P is it's eking out brand new all-time highs today on an intraday basis. We need to hold those highs if we're going to start something sustainable higher that you can put some money in the market and hopefully capture the next leg up. So number 3 here is following the money. It's our SEAF model. Our SEAF model is sector ETF asset flows. And I built the model about 6 years ago. And what it does is rather than track the performance of one asset versus the S&P, or one asset versus another asset, it actually tracks the money flows inside of the 11 sector spiders. And it does it in 3 different time frames. We'll have a look at that. And the reason I'm showing you this is when the market is choppy, when the broad market is choppy, or when it's been drifting sideways for a couple of months, which is really what the S&P 500 has been doing, sometimes the best thing that you can do is find out where the money is going and try to see if you can ride that wave. And that's what SEAF does. So you can see right now, we have 3 different time frames for SEAF. We have trading, 5 days, tactical, 21 days or 1 business month, and strategic, 63 days or 1 business quarter. And we track the 2 biggest percentage assets in and assets out for each of those 3 time frames, and the ins are green and the outs are red. So you can see over the past week, the 2 biggest percentage asset flows in went to financials and energy. Those are both new trends since 6/3, which was the closing date of the last time we updated the model. It's updated once a week. And the 2 biggest assets out were technology and consumer discretionary. So to cut to the chase here, the 2 signals, active signals right now, are an overweight in financials, which has actually been in effect since November the 12th, and a new signal to overweight energy. And that energy signal has actually been in place also. It actually originated on November the 12th, and we've been in and out of that one time. So I'll show you what we mean by that. Again, asset flows typically lead price movement, and that's what SEAF is about. So here's the financial sector. It's been the second best 6-month performer in the S&P 500. And so our signal on SEAF came on November 12th of last year to overweight XLF. You can see since then, XLF is up 42%, and it's outperformed the S&P by 19%. And this chart on the bottom shows the relative performance of XLF versus SPY, which of course is the ETF that tracks the S&P 500. You can see that it's stayed on a 63-day basis or a quarterly basis. The relative performance trend has been positive since the beginning of November, and it's tested that trend twice, in late January and about the middle of April. That trend is still intact. So that's just following the money. The advantage to following the money is by the time the story gets out and you start to read it in the paper or it's on CNBC, those trends are usually pretty mature. Back on November the 12th, with the yield of the 10-year trading well below 1%, not a lot of people wanted to buy financials. But following the assets, you can pick those trends up a little bit earlier. And finally, number 5, the energy sector is the best 6-month performer and the best year-to-date performer. So here's that chart, and here's our signal on November the 12th that came from SEAF. It had us in on November 12th, but had us out on April the 9th. So we had captured a nice move here, 45% outright and an outperformance of 27% versus SPY, but it hit us out here. And you can see the signal was generated by asset flows coming out of energy, but while that happened, the relative performance line between XLE and SPY, it actually dropped below its 63-day moving average. It looked at this time like we were beginning a new trend of relative outperformance. The money came out of XLE, so we got out of the way. That trend actually, the signal showed up again on SEAF on May the 3rd, which you can see here by this green line. And since then, we've picked up a little more outright performance, up another 12%, and we've outperformed in this latest move of outperformance. We've outperformed by 9%. So what we try to do is not only get the big picture right and get the S&P 500 right, but sometimes when the S&P is going sideways and there's a lot of chop, if you look under the hood of the market and see where the money's going, you can find opportunities that can get you some extra relative performance while times are good. So there's your daily 5 for this week. You can get more information about us at www.asburyresearch.com. Thanks for listening, and we will see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.